This is Thinking Byzantine, and today we will be going over the Spider S&P 500 ETF Trust. But before we do that, like and subscribe for more content like this. Now here are the overall stats for SPY, or the S&P 500. This ETF was founded January 22nd, 1993. It has an expense ratio of 0.09, around 314.5 billion of assets under its management, which makes this a pretty big index fund. And it has an average volume of 23.1 billion, which this will be important later. Current dividend yield is 1.53, and the current price is $360.21. These two, current dividend yield and current share price, will change as the price goes up or if dividends are slashed. And the average rate of return is around 3.6%. Now, why would you invest into SPY? SPY is very defensive in its nature, as it's an ETF that tracks 500 companies, making it very diverse, and also it has great option choices. So these are for your people who like running the wheel or selling options, buying options on SPY, mainly because there's option expiration dates on Monday, Wednesday, and Friday. Most of the times, unless there's a holiday. Now, the top 5 holdings of this ETF are Apple at 6.43, Microsoft at 5.46, Amazon at 4.23, Alphabet, including Class A and C, at 3.51, and Facebook at 2.3%. Now, looking at this, you can tell that this ETF is going to be very technology focused. Not focused, but very technology heavy, as we will see in the next slide, as technology is 34.4% of this ETF, while consumer cyclicals at 4.59, healthcare is at 13.88, and etc. And as you can see, that this ETF is not very heavy on telecommunications or energy, but it's still there. So for people who do not like AT&T or Verizon or Exxon or Chevron or any of those type of companies, maybe something like SPY-X would be better, which doesn't have energy or cuts out those big oil companies that no one is very fond of right now. But in most cases, it's still technology heavy, which some people may not like. So maybe a value fund would be better for those who are trying to get more bang for your buck while expecting less growth. But in any case, let's look at its competitors. So we have iShares, IVV, and Vanguard's VOO. Now, you can see that VOO is the youngest of the three, as was founded in 2010. IVV was founded in 2000, a bit later. But you can look at something I think is very important for index fund investors or people who want to buy and hold for a long time. Expense ratio. IVV and VOO have a 0.03 expense ratio, while SPY has a 0.09. So these right here will eat away at your returns. And VOO recently dropped their expense ratio, and IVV mirrored it, while SPY is still stuck at 0.09. These are both big funds at 2.29 billion and 174 billion. But here's where SPY has an advantage over these competitors. Average daily volume. IVV is at 1.25 billion and Vanguard's only in the millions. So trading, if you're a day trader or you use options, SPY is just a better fund to use, as it's just more liquid. You can get someone to buy your stock, and you can always buy it if you want it. And the dividend yield is similar at 1.66, 1.58. Share price is in the 300s. Average rate of return, or return on investment, ROI, is still around the same, but I still think IVV or Vanguard would be better if you're just going to buy and hold, while SPY is for your traders. Now here's some graphs. As you can see with IVV and SPY, their return rates are similar. Then can be set up VU. And if you want more information on these ETFs, I suggest ETF.com or ETFchannels.com, where I got these graphs. And thank you for watching this video. If you want to watch more videos, I'll be coming up with some more ETF overviews and maybe some stock overviews in the future. In any case, this is Stinking Visiting. Please like, subscribe. Goodbye.